The seniors housing industry has been changing, has been improving. The skilled nursing industry has been having its ups and downs with reimbursement. It's hard to know where cap rates are, what cash flow to value. And so I have here with me today Alan Plush, senior partner at Health Trust. He's been doing this for well over 25 years. So he is definitely an expert in the valuation of all kinds of healthcare properties. And Alan, the seniors housing market has really improved in the last 12 to 18 months. On the appraisal side, what have you seen in terms of financial and operational improvements?
Well, Steve, first I want to just correct one mischaracterization. Well over 25 years, slightly over 25 years, if I could just make that edit. Steve, it's been very interesting over the last couple of years. We have seen, I kind of look back to 2011 as obviously there's a lot of transaction activity, and we saw a large amount of the trends then were obviously the repurchases and the influences that those had. We've seen an evolution in the last, probably since August for us it started, away from the larger transactions and back to more singles and doubles, and we're also seeing a different type of client enter the market now, being the commercial lender, and they're kind of slowly making their way back. So we've seen a number of changes in the last 12 months.
But have you seen from the operational side, have you really seen improvements in cash flow, other than with skilled nursing and the cut in rates last October? But.
That's correct. That was obviously a big impact on cash flow, and I think it was a relatively well anticipated impact on cash flow. But nonetheless, but on the nursing side, there has been a lot of activity surrounding those in the evaluation sector. What we've seen on the senior housing side is a steady improvement in occupancy, and I really like to characterize it as if you look at the two factors that, in my mind, that influence risk and fear in the sector. It's availability of capital and occupancy rates. And if you had to just pick two issues to focus on, I look at those two on a regular basis. So we're seeing improvement in occupancies, and we're seeing a greater availability of capital. So from my standpoint, I think the fear index is coming down, and that's probably the biggest change we're noting in the last probably 9 to 12 months.
How about lender attitudes as the economy improves? Are they getting a little bit more liberal in their lending parameters and underwriting criteria?
Yes, Steve. One of the interesting things is recent is, in fact, on my way here this morning, I ran into an old friend who's a lender and has a position at I would call it a regional bank now, and they're doing construction loans in the senior housing space. And I think whereas, say, 9 to 12 months ago, I don't know if there was anybody actively engaged in new construction lending other than HUD, and of course that's very problematic to get to. It's very time consuming to get through that process. We just really didn't see there were a handful of small groups that would do it, but there was very, very little available. And now my feeling is that we're seeing the needle kind of change real time. And I think you're going to see there's a fund I'm familiar with, a senior debt and equity fund that's doing construction, and now here there's a couple other lenders that are doing new construction as well.
Well, we're going to have to get that name of that bank from you later on. That's doing construction.
There you go.
What comes across your desk more frequently on the appraisal side? Is it acquisitions or is it refinancings?
Well, that's that evolution I talked about. I think a year ago it was acquisitions, a lot of acquisitions, and the market it's a choppy market. So we'll have one. There are a handful of acquisitions we're working on right now. At the same time, and when I talk with brokers active in the space, there's a lot of near misses on the acquisition side. So mainly what we're seeing now are refinances. Supposedly 2013, there's late 2012 and on into 2013, a large amount of the agency debt that was used to finance some of the asset pools that were picked up by the REITs. A large amount of that debt is up for renewal, and I think you're going to see either a wave of refinancings at that point, or a wave of just pay downs and balance sheet shrinkage on the part of Fannie and Freddie. But really we're seeing mainly, most of what we do remains lender, is lending related, and not as much involved in acquisition right now.
Okay. And everyone's talking about cap rate compression in seniors housing right now, but isn't there a pretty decent spread in cap rates between the institutional A quality properties and the B properties? And any idea what that spread might be, and do you think that spread's widening as more of the A properties come on?
Certainly, I think the spread of folks ask me all the time, of course, what's the cap rate, and I always tell them, well, that's easy, 6.5 to 10, and which really leads into the fact that the bifurcation we've always seen, I think now is more pronounced, it's more acute than it has ever been. Institutional grade assets, of which there's a dwindling number of that are concentrated in a size to attract acquisitions by the top three REITs. Those pools are, I believe, we've seen most of those come through the system, and so a lot of what happens now is the second tier assets, and again, this is not a disparagement against the quality of the operations or the physical and anything, but for whatever reason, they're not the A quality, they're not on the A assets that a REIT would buy. So we've seen, probably if you wanted to use a 6.5 to 8 range, maybe 8.5 on those, and 6.5 being extremely rare, but maybe 7.5 up to 8.5 is probably a good range. And then there's a gap, and you'll see second tier assets starting at 9 and going to 10. So I've never seen a gap in there, and we actually believe that there's a little bit of one right now. But the biggest challenge is explain to somebody that, I know it was like back when we appraised the Holiday transaction years ago, and trying to explain to a typical market participant that your independent living facility shouldn't be valued at a 5.75 cap rate just because that was those transactions, and typical of the REIT RIDEA structured transactions, and we could include they've cherry picked and done a good job of picking off a lot of the good platforms and the good operators and pulling them into their fold, but I don't think there's a lot of that left. So
how about on the skill side? I mean, it's got to be pretty hard. You look at someone's 2011 financials, and it's got 9 months with the pre-cut for Medicare, and then 3 months with the post-cut, and then as everyone's trying to figure out how to change their costs, how hard is it to do the pro formas, because the historicals are irrelevant now?
Well, I wouldn't say they're irrelevant. They're just you have to put it into context, and what the methodology that we've been using is that the consistency is most likely going to be in the RUGS categories, utilizational categories. So we will model financials going forward with historic utilization and current rates, and that mitigates that change. Now, that being said, the step back a step, the most sophisticated operators that we dealt with assumed there were going to be cuts, and I'm talking about before they just felt that the RUGS score was the rates were too fat. There was just this sense, even before it became apparent there were going to be cuts, there was a sense that this can't last, because that's how the system works. So there was an anticipation of a compression on those rates, and the more proactive operators were prepared. We would look like I described in terms of estimating gross revenues, but with a RUGS utilization and then a current rate per category to get the gross revenues. But then when you look at the margin, we appraise kind of on a static basis, an objective basis, and then we appraise to a margin. So at the end of the day, we recognize that operators are going to that margins are going to remain relatively constant. However, different things are going to shift. So I believe that to accurately appraise a nursing home, you have to look at both, and that gives us a cross-check. So if we do the new math and we end up with a margin that doesn't make sense, then we know there's going to be expense cuts to follow. and then we dig deeper and we see what's logical in that regard.
Are lenders, taking a very conservative approach on this? Because I'm sure a lot of them don't know that reimbursement detail very well. I mean, how are they looking at some of these pro formas for their loans?
Sure, there's two types of lenders. There's the specialty lenders that have dedicated specialty groups and really are tuned in and are making their assessments and based on what they see. And then there's the maybe folks that aren't in the space as often and don't have a concentrated team. They're the more cautious of the two, the latter. The former, I think, get it, and they understand that the operators are going to make adjustments. They understand that in the immediate, there's an initial impact, and then you'll see margins kind of correct back to a normalized level. So the degree of caution obviously it increases with the less familiarity you have with the space.
Mm-hmm. How is today's market? You look at I would say in the middle of a bull market. How does that differ in your mind from the 2005 to 2007 bull market?
Bull market for senior housing.
Yeah.
Yeah. One of my thoughts is whether or not we're still in the bull market. If the bull market was started with the purchases of the operating platforms by the REITs, if there aren't many of those left to buy, I think the Ventas purchasing NHP is a perfect example of an acquisition that makes sense, I'm sure, but this is what you do when there's not much else to buy. And so I think my feeling is that 2012 is going to be a relatively flat year for all of those reasons. I think it's a singles and doubles year. I think we're in the tail end of a bull market only because I think we lack product. That the current buyers, the profile for the buyer right now is typically a REIT, and I think that the type of stuff they want to buy is dwindling. So, but when you look at the 05 to 06 back in that period, there was I think there was a different backdrop to everything. That we hadn't lived through the Great Recession. There was the expectation that values would continue to rise, and therefore the purchase price, there was a frenzy to buy assets. There was a tremendous amount of liquidity, and values were going up. It's almost like your single-family home. I mean, the psychology became, well, whatever I spend on my house, I know I'll get back. So the more I spend, the more, and I think we had that in our industry too. That psychology is not there. There are two portfolios I'm aware of just in the last few weeks that were on the market, and the sellers pulled them because they didn't hit their pricing expectations. It's just a different market right now.
Was it pricing on a per unit basis or pricing on a cap rate basis?
Aggregate dollar basis, period.
Okay.
Here's what we think they're worth in multiple millions, and the offer came in less. And the highest offer that we could get to was actually 3%, 2% less, and we won't do it. And and in one case it was maybe 5 or 7%. The other was, So again, it's just a different. It feels different. And when I looked at, I remember back to the days, and I use the Holiday transaction as kind of as a high water mark. Maybe it's easier to mark in my mind, and the activity and but you also didn't have. I mean, we have a national economy that's fragile. We have a world economy that's fragile. And that psychology is seeps everywhere. And in the valuation industry, we look at the objective facts, but if you don't understand the psychology of it, I think you miss a lot of the dynamic that's going on when you're valuing properties. And I just feel that the psychology, buyer and seller psychology, and investor psychology is very different.
Well, I know you told me you valued over 1,400 individual properties last year, and I hope you can maybe match that or exceed that this year.
Well, I don't know that we want to. I think it's a different world, and what you do in a one type. I mean, we're at Health Trust. I think we've prepared ourselves and for the shifting in the economy, and if we do less than that, we're fine. But but you never know. We, like so many people in the industry and in the third party space, are we just sit by the phone and wait to see what transpires.